I'm going to say it's a mentality, and it's scary as well. I can't, deny it can be very nerve-wracking to hit that buy button in the middle of these kinds of plummets. I think the U.S. will continue. I like to look at sort of what has been happening over a long period of time, and I give a lot of weight to that. The dominance, the way they have come to dominate up until now, I don't think that's disappearing. Then the valuation does not matter as much to me as it does for something like, these sort of more mean reversion things where you're buying something that has been pummeled and is now at a 52-week low.
Welcome back to the Dutch Investors Podcast. Today on the show is Joel Sherwood, an American investor writing about his passion on Substack. Someone who lived in the United States and now lives in Sweden for over 20 years. He has a front row seat on how companies, especially in Nordic areas and serial acquirers, for example, operate there. Let's jump into today's conversation with Joel Sherwood.
Great.
Did I pronounce your name right?
You did. Joel Sherwood. Absolutely.
Joel Sherwood.
Yeah.
It's good to have you on the show. We went back and forth for a couple months and things happened in between, but we're here and excited to have you on the show.
Great to be here.
We've been following each other for a while now. From what I've seen, you focus especially on like the Nordic companies, European companies. I'm excited to ask you some questions, how you think about investing, how you think about finding quality companies. But before we get in, what is it about investing that intrigues you? What got you into the world of investing in the first place?
Well, let's see. I've been a financial journalist for a while, and my background is in journalism. And I've also worked at banks now for over 15 years. So I've been into sort of the financial world for a while now. And, I think it's, when it comes to investing, it's such a sort of intellectually demanding sort of task that sort of really rewards you in the end if you can do it right. So I really I like that challenge, and I like the idea of sort of, the process. I'm more into the process than sort of the results. I believe the results will come. But if you can find that process, find a way to sort of do this, find a system, find a way to do this, then it's a nice way to spend my free time, you can say.
Yeah, absolutely. I agree. I think it's one of the few topics, if you could call it that, where it combines everything: psychology, money, the way people think, the way the world works, economics. It combines everything into one. And I do really like the challenge, the process. And what I find difficult myself, and I don't know about you, but you never really know whether you made a right decision or not, right? So you can make the right decision now or next week. You can be up next year, but you can be down 5 years from now. Or where did you make the mistake in the process, in the end result? How do you think about that? I find it very challenging.
That I couldn't agree more. And at the same time, I think that's a real opportunity as well. So this idea that sort of, I think a lot of people are out after sort of instant results, instant gratification. This is kind of true in life in general, and I definitely think in sort of investing. And, so if you can somehow overcome that and really kind of think in terms of years and decades, that's I think that's sort of a superpower if you can actually pull that one off. So, and it's, I guess investing kind of trains that muscle as well, doesn't it?
It does, yeah. So what do you like to do? Do you like to read a lot? Do you read books? Do you listen to podcasts, go to conferences? What is it that you like to do when it comes to investing?
So I have read a lot. I read a lot. I have read a lot. I've studied it. And I sort of started realizing a few years ago that, like, kind of in my free time, I was kind of looking this stuff up. I was reading those investment books and kind of following earnings when I didn't really need to be doing that, and probably should have been watching Netflix or, doing something else. So it really kind of evolved. I kind of slowly but surely. And then, it kind of snowballs once you get into it. You really kind of
get addicted.
You get addicted, and you find that next thing, and then you sort of you learn something, and then you say, oh, wait a second, they were talking about that thing, or mentioned that book, or mentioned that guy, and then you sort of go on to the next ones, something like that. I listen to. So I have a dog. And when I'm out walking the dog, we listen to or I listen to investment books as well. Then, so that's, I don't know if listening to a book, does that count as reading?
Sure.
Let's say it does.
Yeah.
So that's something as well. So that's, I think it kind of has to be that. Has to be something that you sort of really have a drive for, a passion for, and you do it in your free time.
Yeah. It's about how you consume information, right? It doesn't really matter whether it's through listening or reading. I think it both has a place. I think reading is very underrated. I think as an educator myself, I see a trend where people are reading less and less and less. But the people that actually read a lot, you can tell by their intellect that they read a lot. They think differently, and I think it's a lost skill. I think kids should read a lot more, but it's boring. It doesn't move. It's not fast. It's not fast paced. You can scroll through TikTok and stuff, and you don't get the dopamine shots lots of children are looking for. But anyway, I thought it could be fun just to get started to play a little short game where you can only give a single answer and you have to choose.
Oh, good.
Just to see what kind of investor you are, and just to see what you think.
Let's do this.
All right. In a perfect world, do you think everybody should invest somehow?
Yes.
Okay.
Right. It was a one word answer.
Yeah, for sure. What market will have the best returns the coming decade, you think? The United States, Europe, emerging markets, Asia?
So what was the time frame? And the next
coming decade?
US.
Really? Why?
I thought it was only one word. I think they still have the advantage. There will be sort of pockets of outperformance in certain other areas, but I think the dominance, the way they have come to dominate up until now, I don't think that's disappearing in the next decade or two. So sure, there are contenders, and there will be shifts. Maybe it's sort of a kind of Europe's time a little bit right now. And the dollar is maybe a little bit weaker. But no, I think the U.S. will continue. I like to look at sort of what has been happening over a long period of time, and I give a lot of weight to that. And so I think that if something has been going on for quite a while, it's sort of bound to continue. I think
Lindy effect, right?
This is Lindy effect, exactly. So we have that here.
Yeah, I'm not saying I disagree. I'm just wondering why you made that decision.
What's your answer? Yeah.
I do put a lot of weight on like what history tells me. I'm a real history guy, and I think that people always make the same mistakes looking back. So the chance that America will be the best performer the coming decade is very likely. But I do think that Europe has a very good set of cards if they play it right, where they can sort of become like the trustworthy partner for other countries and other continents. And obviously the elephant in the room is China, but they still have like the political red flag that a lot of people don't like to invest in. So it's probably going to be America, but I wouldn't be surprised if Europe, if they keep playing their cards right, loosen the regulation a little bit and, invest in businesses. And I wouldn't be surprised.
I mean, this is one of the fun things about this is that, you never know, first of all. And I mean, it will be very interesting to follow this very closely and see, of course.
Yeah. We'll have to do this again 5 years from now.
All right.
And see what. All right. Next one. Your favorite European company right now? Ignore valuation, just your overall favorite European company.
I mean, I don't really choose favorites like this. I mean, a company I really look up to is Investor. So Investor AB, this is a big Swedish holding company. So, I mean, these guys are amazing. You really can't sort of, overstate significance to sort of the Swedish economy. And they're just a model for long-term ownership, long-term holding and compounding, which is sort of what I'm after as well. So family owned as well for, many generations. It's a cool story.
Yeah, we might get into it. If you had to hold one company for the next 20 years and you can only pick one, which would it be Investor AB or a different one?
Yeah. I mean, maybe it would be Berkshire.
Okay.
So I'm big into holding companies. I really like the sort of, having multiple assets that you sort of control. This is different from, companies with, sort of one or two or a sort of series of products that are selling like crazy. This is always a good thing. This is, what sort of economies are built on. But, you never know what happens with this. So when you choose sort of one company, it looks amazing. It's going like gangbusters. That's great. If it fails, then you're sort of out of luck. With something like a holding company, you have some built-in diversity there that you can fall back on. So if one isn't doing so well, then you have the other ones. I think that's really smart.
Yeah. Yeah, I agree with you. In my portfolio, it's only about 10 companies, but there's a couple holding companies as well. For example, Process for Tencent, 3i Group, it's the discount retail chain Action. So I agree with you. I think holding companies are a great way to diversify in a sense, right? Where one part can alleviate the other and vice versa.
Of course, what you get is with that diversification and that safety, you do lose some outperformance. So there is a trade-off there. So if the question is, you just have to have one, then it has to be something like that where you're playing it safe in some ways. But of course, there is a trade-off. If you with holding companies, they typically don't grow as fast as some of these high growth companies. So you're making a trade-off there, and I definitely am also a believer in sort of the sort of diversity, like diversification is diversification or something. So I tend to go for I'm trying to go for more concentrated. Have a fund that is a fewer holdings. So yes, I realize that those are two conflicting points of view there, but for very, very long term, then something like a holding company is a safe bet.
All right. Final one. Do you think AI is currently over or underhyped for its potential?
So it's of course, it's the big thing. I personally use, more than I realized I would, actually. I'm a little bit sort of tech averse. I'm not super into tech. And that definitely is true for investing. But so AI, I mean, I think it's very, very real, and it's going to impact, basically everything. It's become something that we really don't even think about. So in that sense, that it's maybe underhyped in kind of our sort of daily use and kind of how it's going to impact our, our society. in an investment standpoint, I think it's is it overhyped? I don't know, but I don't really get into it very much.
I'm assuming you don't own any like very AI related stocks.
Do not. No, I'm trying to think, but yeah, no, in fact, that would definitely sort of turn me off. I think I have a little bit of NVIDIA, but it's like kind of like as a benchmark compared to other ones. So, but otherwise, look, not at all, because it's really early days. We don't know where this is going, and so it's really hard for me to make any kind of long-term assessment on sort of, who is going to be the winners here and stuff like that. So no, I actually avoid it.
Fair. Just out of curiosity, you told me you work for a bank, so I assume you work with lots of financial people, financially literate people. Have you noticed AI helping out, like, in your daily job? Do you see it changing how your job is being done a couple of years from now? Has it become... I'm just curious what happens in like the financial world with AI and what you see in person.
It's happened really quickly. It is profound change. There is really a lot happening, and it's all happening very fast. And I think, certainly in the financial analysis world, then this is going to be key. There's no question about that. And I use it, for my, independent investing. I mean, this has become an absolutely, vital thing for me. And if it's vital for someone like you and me, of course, it's going to completely change the financial analysis, equity research industry. No question about that. And then, of course, banks are in some ways a reflection of society. So yeah, we will feel that just as every other thing does.
How would you describe your investing style? That when you look around, you see growth investors and quality investors, and I think it's all a little bit nonsense. I think everybody should be in some way just be an investor, no better. And it's always like a balance between risk and reward. How would you describe your investing style?
Great. Yeah, exactly. So I try to think very long term. And that's sort of both for me, when I make a move, I'm thinking very long term. And I also want the company to be very long term. I want to see that they have sort of decades, ahead of them. And that's a big, that can be hard to find. You don't know that, but I really want to kind of feel sure, or as sure as I can be, that this is something that's going to make sense, not only now, but in the future. That's why sort of maybe some startup AI, hot startup AI company, you don't know, because you don't know if 5 years from now there won't be another new startup AI company that is even better. So, something that actually isn't that is easier for me. So very long term, I'm focused on sort of protecting the downside. I want to have margin of safety. I want to be sort of, I'm not trying to buy sort of at the top and ride some sort of momentum. It's quite the opposite. I want to, zig when the others are zagging. This is a famous investing phrase. I'm into sort of being very sort of rational about what's going on, which to me means sort of like not getting caught up in the noise, not getting caught up in the headlines. I want to see past that, and I want to see sort of like, okay, what's sort of really going on? I think a great example of that is last year when sort of oil was just really out of favor. Like nobody cared about oil. There's a big, headline in the FT about sort of, the outlook looks horrible for decades. That's bad news for the oil industry. That, to me, that's good news. Bad news is good news. So when I see something like that, I know you're not going to be overpaying. You're not buying the hype, and that is a good time to buy. And then sure enough, what is it, 6 months later, something like that, here we are, and everybody wants oil. Like it's the hottest thing in the world right now. It's a great example. 6 months ago, nobody cared. Now everybody wants it. I love this kind of stuff. So, this means buying sort of at the lows. I love 52-week lows. I want to see that, buy as much as I can. Stuff like that. Yeah.
So how do you do that? Staying out of the noise, avoiding the headlines. How do you stay rational and not get influenced too much by others? What helps you?
I mean, I guess it's a mindset. It's a decision. And then, when you see those lows, when you see the sort of, like I said, when you see the bad news, to sort of train this muscle where you say, you know what, like kind of, when the house is burning, you kind of run into the burning house, running into the fire. Something like with Novo Nordisk, for example, they had several big sort of, drops last year. I think even one earlier this year. And this is kind of thing, as it's dropping, you buy more, right? You run into the burning building, this kind of thing. So it's I'm going to say it's a mentality, and it's scary as well. I don't want to sort of, deny that it can be a little bit, or it can be very nerve-wracking to hit that buy button in the middle of these kinds of plummets.
I would like to expand on this a little more, because I think this is something all investors face. If you buy individual equities, somebody is right and somebody's wrong. Somebody's buying, somebody's selling. Where there's smoke, there's fire. So when a company is at a 52-week low, there are people seeing things which makes them sell. I've been asking this question to some of my close investing friends, and the answers vary widely. But how do you determine whether you think you're right and somebody else is wrong? I think Novo Nordisk is a very high quality company, but there's a reason it's dropping. And so what makes you decide to get in when it's so low and the narrative is so bad?
I think you're right. The market isn't wrong, and I really accept that. I know analysts, and I really appreciate what the analysts say and their research and their conclusions. The market isn't wrong. So what I typically think is that it's overreacts. Yes, there is some bad news there, but it goes too far. And the same is true on the opposite side. When there's good news, it goes too far. You get too excited. So that's when you see these valuations that are sort of, sky high, that don't make sense. So it goes, it's this sort of Mr. Market, manic depressive. It's too high and too low. So it gets the news, but it reacts too much to it. So I definitely think that's one thing. And that's something that you sort of say, okay, where is that overreaction? How much does it have to go down to sort of be a regular reaction, just a correction, or an actual overreaction? And that's a judgment call. You can try to base it on numbers, but you can also go by sort of like a company that's been around for 100 years drops 20% today on some kind of one news item, stuff like that. It seems extreme. And then I think, the other advantage is to think that, it's if you do think long term. So a lot of times what's happening is these are sort of short term, gains and losses, and the market is reacting to, on kind of what's going to happen in a couple, maybe minutes, weeks, months, maybe a year or something like that. And if you have a 5-year frame or longer, then you don't have to worry about that. So yes, the market is right. Probably if you're gonna, in the middle of that dip, you want to sell because it's going to go lower for a while. So the market in that sense is right. And then of course they're wrong, because why would you give away a really good company for such a low price when in 5 years there's a very high chance it's going to recover and doing much better. So something like that.
That makes sense. Yeah. I think I'll have to agree with you. It's about a time horizon, right? And it depends on your style, I guess, as well. If you're a trader, it probably makes sense to buy and sell lots more often and when it drops. But yeah, it's difficult even for someone who's been investing for years and maybe even decades. You never really know if you're right until you decided what to do with your company, whether to hold it, sell it, buy more. It's difficult. It's the unknown.
That's the unknown, and then again, that's sort of what's also a challenge. Not knowing is can also be an opportunity in the sense that if you really can kind of give it 5 years, like look at it in that long-term sense. I really think like most people are not doing that. The vast majority of the market is not doing that. So it can be a real advantage. I think sort of stock ownership times have, fallen,
drastically.
Yeah. That kind of thing. So it's, everybody's very short term. So if you can think long term, scary, unknown, but an advantage, hopefully.
And the stock ownership time of other investors actually increases the long-term thinkers, the long-term investors, increases your chances of getting companies that are oversold, right? Which is what we're trying to look for. So what sort of companies do you look for? Do you have some examples?
Great. So yeah, I'm up here in the Nordics. Let's see, what's the best way to answer this? Of course, I'm looking for these, we're all looking for the quality companies at a low price. And, I like these sort of, mean reversion plays. I don't really see them as plays. I shouldn't use that word because I definitely look at it as a kind of a long-term thing. But, a company that has dropped drastically, and its multiples have collapsed, and it looks to be some sort of disconnect between its valuation and its intrinsic value, then, those kinds of things. So here we're talking about, like a Novo Nordisk, for example, that is trading, way, way below its typical multiples. And, given time, you can sort of see that that's going to recover. Or you can perhaps make a bet that that's going to recover. I should say quickly that, these are not recommendations. These are only opinions. I in no way am allowed to give recommendations. This isn't a recommendation. So I'm just speaking about my opinion about companies. So you have the mean reversion aspect. And then the other one, and I think we should get into this a little bit, is these serial acquirers here in Sweden. These are compounders. These are companies who are about, their business is actually buying other companies and compounding. This is a fantastic thing going on up here in Sweden. And if you can somehow get a combo of these two, then I'm loving that.
Yeah, we can definitely get into that. We've noticed that in places like Sweden, Norway, Nordic countries, there are a lot of companies with families behind them, many serial acquirers like Technion. You could probably name a few others as well. So why is that, you think? What makes the Nordic countries such a good place for serial acquirers and family-led businesses to thrive?
Okay, so why has it started from there? Why has this become a hotbed? I think there's a tradition of it. I think you have a tradition of, for example, investor sort of, buying and holding companies in the long term. And then you have, there's sort of, it comes from the serial acquirers that we have now. A lot of them are traced back to sort of one company that didn't really start doing this, but sort of got into this eventually. And then I think it just it's kind of developed from there. There was a crisis in the 90s here in Sweden, and I believe that forced companies to sort of start to focus on making sure that the companies that they acquire are sort of very asset light, very profitable, very efficient. So, a crisis kind of, sort of fueled the flames of this. And this, generally speaking, something started to work here. There's long-term ownership. there's, sort of thing like family ownership. And then there's this sort of, thing of the serial acquirers that started to work and people started to see it. And all of a sudden, then you have this kind of hotbed going on here.
Why are you so drawn into these types of business models for serial acquirers? What makes you interested in them as an investor?
So this is that they have a lot of what I like, right? They have this downside protection because they are diverse. They are buying companies and holding them. And so at the end of the day, you have a company that owns, 20, 50, 100, 200 other companies. This is a nice, safe base that you can sort of fall back on. And then the next thing they do, it's math. They have a system where they just continue to buy companies. The wheel just keeps turning. There's no end to the amount of sort of niche companies that they can that you can find around Europe, and it's a machine. It can just continue to just the machine can just keep rolling. And other companies don't have this. Most companies are they're selling a product or they're selling a service. And if people don't want that product or service anymore, they're kind of out of luck. They have to sort of do something else. Whereas the product or service that these guys are doing is compounding, is capital allocation. That is the product. And as an investor, I mean, isn't that what you want? You want a nice, safe foundation. And then you want, a company to be able to continue to grow itself forever.
Yeah, that's what it's about. Okay, so let's talk a bit more about that serial acquirer playbook. And, let's say you're looking for a serial acquirer. You're interested in those types of companies. Someone is listening. Maybe you've read a couple books, you saw the successes of companies like Constellation Software, Topicus, maybe even Berkshire, and you want to find one yourself. So where do you start? How do you typically look for these serial acquirers? I mean, there are hundreds of them. So how do you know which ones to pick and to avoid?
So I think in one way, there's sort of there's a history of this. And another way, it is kind of new. It is a newer thing, at least in my understanding of it. It's kind of something in the last, I want to say a couple decades, maybe 3, so.
Yeah, 2-3 decades.
2 or 3 decades. So there isn't a huge amount sort of written on this topic. In book form, for example. Of course, there's sort of research papers and equity analysis and things like that. So the point I'm trying to make here is it's kind of a new thing. And then the playbook has in some ways been established by some of the big players. Okay, you got Lifco, you got Indutrade, you got AdTech, you got Lagercrantz. These are sort of the big Swedish serial acquirers. So that's good. That's been established. They're there. They're still doing their thing, actually, which is pretty cool. They still got that sort of 15% revenue growth and 19%, earnings growth and stuff like that. Still, it's amazing. What I think is really cool is that now there's kind of come in a second wave of this. Guys who have actually sort of, they've learned the playbook, they know the blueprint about how to do this, and they're kind of branching out on their own. And so you have smaller sort of players coming into the market, or they've been here for a while, but they're establishing themselves, who are the next in line to do this. And this I find amazing. I mean, we all are after the sort of the 10 baggers and the 100 baggers and this kind of thing. So the first phase of these serial acquirers have done this already. Awesome. Now comes the next group, and I'm loving these guys, actually. So this is what I'm looking for.
When a a serial acquirer owns dozens, if not hundreds of different businesses, do you actually try to understand every single one of them? Or are you basically just betting on management to making the right decisions? How do you think about it?
I think it's hard to become an expert of 200 companies or something like this. I am very focused on the owners and the ownership. I think, in fact, this is true for everything I do. I think the owners is much more important. I mean, it's sort of all kind of comes down to that in many ways. And that's kind of dating back to kind of like find inspiration from that from Investor as well. So I'm very focused on the owners. And what I want to see is something that's really going to be long-term and that they really have sort of skin in the game. So I'm less inclined to go for a company that is sort of owned by institutions and private equity firms and stuff like that. I'm much more interested in if the sort of owners are sort of, the founders, they're still there. They founded the company. They still own it. They have significant stake. This kind of thing. So this is something I really look at. Another thing I really look at is the size of these guys. So, and I want, in some ways, sort of the smaller, the better. Of course, it's risky. It's much, much better to sort of, when you have Lifco or something like this, so they have their 200 companies or whatever it is now. When you get these other ones and they have, 20, right? They have 30, they have 10, even sort of, if they're still kind of 90s, one of the companies I really like, I think they have around 90 or so. So this is kind of, I'm looking at the actual number of companies, the number of sort of, and also their market cap. And so these types of things are very important to me. And then also I'm looking at, I want to see a niche that makes sense to me. And so, it's not necessarily any individual specific company. I sort of like it when they are, when the niche makes sense. One of the companies is in sustainable tech. So this is kind of a good thing. This is, clean water and valve technology and this kind of thing. So district heating pumps and things like that. It makes sense. They get sort of, government contracts and these kinds of things. It makes sense. It feels stable. So I'm looking more in the sectors and the niches.
Yeah, and maybe incentives.
I mean, definitely. So I mean, absolutely. So if you have the owners, with large stakes, they have skin in the game, and then I want of course the CEO to have skin in the game and be sort of a big owner of the company as well. So this is sure, this is an incentive. Then, okay, you have also this, and this is this is something that the Swedes have perfected. And that is, you have to get companies to sort of sell themselves to you. And in this way, you have to be a good owner. You have to be a responsible owner. And I think when you have some sort of private equity firms, sometimes they have been known for coming in and gutting the place and maybe loading it up with debt and selling it onward, at a much sort of worse version of itself, and maybe in some ways destroying the legacy of the people who founded it, the family who founded it and sold to the private equity firms, this kind of thing. This doesn't feel good. I'm sure it's a good moneymaker, but kind of
makes sense.
Sound like him. So I think it's really important how these guys handle and treat and are as owners of these companies, because they keep them. It's very decentralized. They keep them, they let them run. They want them to continue to grow and to continue to sort of dominate whatever niche they're in. And to do that, you have to be good. You have to be a good owner. And so that I think is really, really sort of important. I think some of these guys almost advertise the fact that we never sell. We're not going to buy you and then sell you on further. So these kinds of qualities, it's not exactly which company specifically becoming an expert in each company. Of course, I'm also looking at, you have to buy at a good price. The model doesn't really work if you are paying too much for companies.
I think that's a good segue, because valuing a serial acquirer it feels a lot more difficult than a simple, I don't know, software business that generates subscription revenue. How do you think about valuation for any company, but also specifically serial acquirers? Do you just use regular price to free cash flow? Do you build a valuation model? Do you just look at averages and see where it sits? Like Buffett always says, I use napkin math, or how do you think about valuation?
I think one of the things about these companies is it's good to look at the value in terms of the earnings before interest, taxes, and amortization. So this level is actually, this is the level you want to be looking at. And then, when you see that you've got your sort of Lifcos and the sort of the big players. They're sort of up there. I believe if I checked, I would see them kind of up in the 20s or something like that. So then on this number, you want it to be down. If you see that it's significantly lower than those guys, this is something I look at. This is very important to me. So I don't want to be overpaying. Also, I want to see that it's sort of gone, sometimes perhaps at these 52-week lows or something like that. If there has been some issue, something that sort of pushed them down, preferably for no reason. I want them to be pushed down because the whole market is worried about oil or war or something like that, which has nothing to do with how these guys are running their operations. So some sort of, superficial push down, this kinds of things. And you can see that in the valuations as well. They react just like everybody else. And that's a big opportunity. There will be some sort of big market scare coming up, and there'll be a correction in the market that will push everyone down, 20, 30%. This will be good for them. This kind of sort of, what could you say? That's more of a macro issue that pushes these. So it's this kind of valuation. And then I also have to say, in some ways, I am much less concerned about the valuation of something if I get the feeling that they are going to be able to continue to compound for the next 20 years at sort of 15 to 20%. So if you really have a good feeling about that, then the valuation does not matter as much to me as it does for something like, these sort of more mean reversion things where you're buying something that has been pummeled and is now at a 52-week low.
I agree. I think this is overlooked often. I think if valuation is very important, don't get me wrong. And I often don't buy a company because of valuations. But the longer your time horizon, the less it matters, right?
Most definitely. And again, if you got the blueprint and you're starting from a small place, each individual acquisition really moves the needle. So you have a long runway. And so just as you say, it's kind of like whatever they are right now, that just might be just kind of a blip if you sort of look 10 years down the road. So absolutely, it's the model. It is the long-term trajectory. And that really takes the pressure off actually trying to find sort of that, that kind of diamond that is now, pushed down to some, low.
Walk me through your process from start to finish, and you don't have to expand on it like fully in detail, but you start at a company, you find maybe something you've read something, you find an interesting company. How do you determine from A to Z whether the company is going to be in your portfolio, or what does the company need to have in order for you to either replace it with something else or be added to your portfolio? I just would love to get into your thought process of start to finish.
So I like everybody, I like quality. You want to see those quality metrics. You want to see margins, and you want to see, like free cash flow. You want to see strong returns on capital. These are things that we're all looking at. I also, of course, want to, as I mentioned, I want to see that I want to have a feeling that it's going to be able to be around for the next 10 or 20 years, this kind of thing. So these are kind of like, this is a starting point. Then, I use the Kelly formula, which I think is really, really helpful. This is an equation. This is for sort of betting. You can go to Vegas and use this. It's really helpful in terms of allocation and what to buy for stocks. So I am actually running the figures and sort of like putting sort of the Kelly formula into action and kind of taking out the results and saying, okay, this one looks like a better bet than this one. And this changes week to week. It definitely sort of is price dependent. If you see something like Adobe, drop like heavily, then of course its Kelly score goes up. So I'm very Kelly score in sort of how I'm on my sort of, decisions, weekly decisions on investing. And then also on allocation. This actually is very helpful on allocation. How much should you have of this and how much should you have of that? So, and I think, allocation is actually almost a harder science for me. It's easier to kind of value and buy a company, but kind of how much should it be versus the other ones can be a very difficult decision. So, here you have a formula that actually helps.
I am unfamiliar with the Kelly formula. Can you just, for a stupid investor like myself, explain what that entails?
Let's see. It's now you're getting me here. It's going to take in the sort of the probabilities. It's looking at probabilities and takes in the probabilities of sort of like losing. And then it also estimates the sort of the gains, the potential gains that you could have.
Are those your inputs or?
This is, it's the numbers for the companies, the sort of financials, estimates, for example. Also, I think you can I think it's based on industries as well. I put this into sort of, an AI agent, and it helps, and it spits out an answer. And then you sort of tweak, in a sense, you can tweak your kind of like what you want. You can, if you're looking for kind of something that says, how is this going to perform over, perhaps the next month, versus say, I'm looking for something that is going to be sort of, a longer term bet. So you can sort of tweak these kind of incomes or inputs.
I just Googled the Kelly formula, and the first word I found is the gambling formula. So that just made me laugh a little bit.
Right.
But maybe it's used for that.
Sounds scary. It's let's see if I can get the history of the Kelly formula. I think it was devised as a way to sort of, to place bets. So of course this is a something to if you're trying to win in Vegas, you should definitely sort of use this. I think, somebody, the guy who wrote the book on sort of, how he beat the house in Vegas, I believe he was doing the Kelly formula, I think, in his head as he's sitting there at the table, So it's a gambling thing, absolutely. Also very, very prevalent in the investing world. And it's actually, what's very typical is something called the half Kelly. Half Kelly is when the outputs from some of Kelly formula calculations would be like too strong. Like it would say you should allocate, sort of 80% of your, capital to this. And when you're in Vegas and you're sort of, sitting with a pile of chips and you get a really good hand, that kind of makes sense. So fine, okay, I'm all in here. But in the investing world, you don't want to be all in. You want to be careful, of course. So it's very typical to do a half Kelly from the results.
Interesting.
I find it very helpful because of, as you say, this is all sort of, in many ways, one big guessing game. And here is some sort of a mathematical formula that helps to
protect the downside.
Guide. Yeah, and to help guide. You can't, like with anything, with any tool, whether it's a screener, whether it's some sort of something AI, you have to make the decision in the end. So these are just guiding you. So I get guidance from the Kelly formula. I get guidance from screeners and things like that. But in the end, you're making the calls, right?
So when do you decide to sell a company? When do you just sell because the stock price has gone up too much and you now have a 10-bagger and you decide that it's a time to cash, or when you're down 50%, or when do you decide to sell a company or partially?
So it's a really tough decision, and I try not to do it. And it's, I think one thing that you read, a lot of sort of the investing legends, they typically say, that they sold too soon. It's a very common mistake. So, and I really take that to heart. And I'm not in it to sell. So I'm very much looking long term. I did make a big switch when I got it more and more into sort of smaller companies, looking for that sort of 10x and 100x and things like that. I sort of had a switch there where I sort of said, you know what, I'm not going to get that 10x from some company that's actually already massive. So what is that? That's sort of I want to say it's a philosophy shift. And then I sell when something doesn't fit into the sort of the philosophy or the sort of the system. And in this case, for example, I talked about oil before. I was actually, in Norway, they have this wonderful, sort of value income companies where you're getting, it's a value purchase, really high dividends. So it just feels safe in lots of different ways. Oil companies, typical example. So this was great. Massive dividend, very low price. It's sort of best of both worlds in my mind. I shifted from this. I just kind of came to a feeling that this is not where I am going to get that 10x, like that super compounding that I'm out after. If you're spitting it out in dividends, then I'm getting it and I'm have to put it somewhere else. They're not doing it themselves like the serial acquirers do. I shifted there. So I actually sold, oil, I want to say, earlier this year is when it was. And it hurts a little bit, now, and it really does. I mean, I'm of course I'm happy where I am now and where I put the capital, what I sort of, shifted into. It does hurt a little bit. So no, it's a hard one. Selling is, even when it falls outside of the philosophy, it's hard. And I think it may be something I can kind of recommend, or a mistake I made is be careful with that in mind. Maybe be careful what to buy. Be careful what you buy, because it is really hard to sell it, actually.
What has been your best and worst investment percentage-wise so far?
Oh, that's okay. That's hard.
You don't have to go into the numbers, but I'm curious about which companies.
Right. So with the fund I have right now, it is actually, I mean, the worst one, that's an easy answer, because that is Novo Nordisk. All right. Those guys, they just go from one bad move, one bad day to another, basically. And I bought the dip and it just keeps dipping. And so that dip has not recovered, and it sort of seems to get worse, actually. So they are down, and that's, and they keep going down. So that's the easy answer. And, I can actually say there that I'm sticking with them. There's somebody who, I've been up here in the Nordics for a couple decades. I have been watching them for a couple decades. So I'm familiar. I have faith there. They are the worst one. I think NVIDIA, this benchmark right now, is the best one that I have. And I'm a little bit disappointed in that. I want to say that maybe I can sort of, in a way to explain, it's early days for my fund. I essentially really kind of started stock picking only last year. Early last year. It's been, kind of a long time in the coming. And of course, I've done other investing, but sort of really kind of kicking this off it's still early days. And so these compounders and other bets that I sort of multiple expansion, these have yet to play out, and that's fine with me. I have 3 to 5 year kind of window that I don't sort of judge myself on until I reach that. So I'm cool with that, but it is early days, and I am ever so slightly disappointed that my best performer right now is the company that everybody else is buying, and is sort of in no way sort of something that I take credit for some fantastic find there, where I sort of beat the market and made some big contrarian move there. I didn't. I did buy it when it had dipped for Deep Seek or whatever, when that was. So, yeah.
That's honest. That's very honest of you. What's one book, investing related or not, that has fundamentally changed how you think about life or investing or money in general?
So I like the Philip Fisher book, Common Stocks and Uncommon Profits. This one really got me to think about quality and think about just kind of really finding those few winners and then holding them. This was an important book to me. I mean, of course, I have to say, I think nearly every investing book has been helpful in some way. So I really recommend them. And of course, I'm speaking about sort of the popular ones that everyone knows about and reads. So what could there be 50 of those? And I think they're all good. You should read every single one of them. So just generally, they all help in some way. But that book stuck out to me. And then the book on 100 baggers.
Yeah, it's really good.
This one also changed, and the idea that one of the main bits of advice there is the best way to find 100 baggers is to look for them. Right? It's very logical. And I kind of realized that I wasn't doing that, I mean, let's take the oil investment, for example, I felt good about it. It felt like a good thing. There's value, there's income, the downside was protected. It was only upside. But, a big oil company, I didn't see it as the next 100 bagger, right? This type of thing. And so this changed me. This one was a good one where you say, you know what, if you're really going for that, then you have to go for it.
I think I bought it when I turned 17, so it must have been like 10 years ago. I think it was released somewhere in 2015, 2016, 100 Baggers. And I remember reading some part in the book. It was about the coffee can portfolio, right? And they told me this statistic that the best investors are debt investors. And I remember being like 17 and I was like, really? There's people making this their job that do this day to day, and the best investors are the people that don't touch their portfolios. And I know that has always been stuck in my mind, where whenever I buy or I sell, I always think back to just don't do anything, right? So it's been a very good book, yeah.
So I saw something very similar, some study of some financial firm that looked at whom were the best investors of their customers. And it was the same thing. The ones who had performed best were the ones who had forgotten that they had an account. They completely forgot for, decades. Those were the best performers. And then the other ones were the ones who were dead. I couldn't agree more.
Which makes our job so redundant and stupid, actually, right? I mean, it's basically just finding great quality companies and then just not doing anything. That's it.
I mean, we're hoping so, aren't we? We're hoping so. It's early days.
Hope so.
I would love that. I love the concept that sort of, the best thing you can do is nothing. Right? That's kind of a good.
But it's also the hardest thing to do.
And I mean, so we're on Substack. And I mean, the news flow there.
Yeah.
And Again, it's sort of this kind of superpower or training your brain to sort of not get really into the noise there. I find myself, of course I do a little bit of the scroll, but I really try to sort of not. I really try to limit it and stuff like that. So yeah, I think that's a little bit of a theme of this podcast now. Our discussion here is sort of see past the noise and try to really try to do nothing, right?
Yeah. But I really believe it's such an overlooked part of investing, and I don't think it doesn't hurt to keep talking about it and mentioning it. The system we live in today is just so designed to release dopamine and always keep us active. What helps me personally is to always think about the incentive of what I'm using. And, brokers want you to buy and sell as much as possible. It's that simple. So just do the opposite of what the business wants you to do. Instagram, Facebook, TikTok want you to scroll through all the garbage on there. Just don't do it. Start reading. Start, doing less. And, that helps me. I am a big believer in friction, for example. I really believe that you should remove the broker apps from your phone, turn as many friction things in between you and buying and selling. So, I don't have the brokerage apps on my phone. I have to open my desktop and log in and use all these extra steps. And it just makes me think a lot longer before making any decision. And that helps me personally. Do you have anything that helps you?
Well, I can also say I'm glad to hear that somebody else, is looking at it the same way and struggling with these kinds of things in the same way that I do. So it's fun to talk to you and hear that we have the same problems, definitely. So the more you can kind of get away from this kind of stuff, the better. I couldn't agree more. So, and then, I think another thing I wanted to add to that was with analysts. I think it's hard to take in the sort of the advice of sort of analysts and the market as well. So I try to distance myself or sort of, when things get kind of crazy and kind of when you really need, some perspective, it can be really counterproductive to turn to analysts and the market at that moment. It's right when you need them. They're almost very common for them to be exactly the wrong people to listen to and to speak to because they're sort of overreacting in some sort of way. So this is playing to the point where it is very tough, and even kind of when you're trying to find answers and stuff like that, the people who you kind of think you should turn to for those answers, the analysts and the experts, are almost exactly the ones who are screaming, sell, like get out, or screaming, AI is going to change everything. So sell every, software company that ever existed. This kinds of things. Is not helpful, right when you need it.
I agree. Yeah. Let's work towards an ending, Joel. I have two more for you. When you look 10 years down the road, what does success look like for you and the fund? And is there an end goal or is it the journey?
Right. I think you have to like it. I think you have to have fun. And I think it's true also with Substack as well. So sort of the writing about it and doing that, the entire thing has to be fun. If I look back in 10 years and, it's been a horrible 10 years because I've been, stressing, that would be bad. I want the opposite. So I think it just has to be something where you look back and say, wow, you really did something that you wanted to do. And this very much is that, I want to sort of see if I can get that sort of compounding magic that I've heard so many others talk about. So of course there's the results, but also just, I want to see that I've enjoyed it along the way.
So before we go, I always end with the most valuable or important lesson you'd give to our listeners? Maybe something you've experienced, a massive mistake you've made, just life advice in general, something you wish you knew when you were young. Can be anything. What would it be? It's a hard one.
You can edit out this silent part here.
No, I think this is a great section. It's called thinking.
I mean, I like the idea that that markets crash and that they recover. This, I think, is a big thing to keep in mind, that there have been crashes and you recover from them. And it's a good thing to sort of take advantage of when that happens. So I was around and I was a journalist during the financial crisis. And so I sort of kind of had a front row seat to that. And it was amazing. I mean, you almost felt like the financial world was coming to an end. It might have, actually. So the idea that you have crashes and then that they recover, and that you can take advantage of that. That is something I would have really liked to have had in me when I was a kid.
Yeah, I think being a rational optimist fits that quite well. Being realistic about how the market works and behaves. But if you're investing for the long term, I mean, you have to believe in some sense that the world will be a better, more profitable, better place 10, 20, 50 years from now. Yes, markets will crash. There will be wars. There will be bad times. I think that's a beautiful one. So Joel, as we end this episode, where can people find and learn more about you?
Yeah, great. So, I mean, I think Substack is the place. So the newsletter is called Sherwood Investment Letter. So just straight to the point there. My name is Joel Sherwood, I think, because that's the handle on Substack. So yeah, and sort of I am documenting my journey. I'm doing, I'm focused on the Nordics, and I'm super into these serial acquirers, which I think is something that everybody should know about. This is a really kind of cool thing going on in the investment community that sort of every investor should at least know about and be able to sort of make decisions on it. So I invite you to follow that journey along with me as I try to sort of realize that compounding magic focused on, this small little, random place way up north in the world.
And if our listeners would like another episode with you, just purely focused maybe on serial acquirers, just let us know. I would be open to it. It sounds unique and interesting and insightful. Thank you so much, Joel, for coming on the show, taking the time to this out of your day. It was a pleasure and I really enjoyed it.
It has been a pleasure. Thank you so much for having me.
Thank you.